Well, good morning, everybody. I'm here to tell you about Australian equities. It's a topic you already know a lot about, so I'll do my best to add something to your existing knowledge. This graph here is just to put things into a longer-term perspective. This is the chance of equities outperforming cash on a couple of assumptions that are down the bottom. We're basically assuming that equities in the long term will outperform cash by 5%. In practice, over the last 100 years, they've outperformed a little bit better than that, 6.8%, but this graph is just assuming 5. You can see that over the short term, there's a fair chance that equities don't outperform cash. In fact, it's up close to 40% over a one-year period. But the longer time goes on, the chance of equities underperforming cash gets smaller and smaller. By the time you get out to 10 years, there's only a 10% chance of equities outperforming cash. That's just a pure statistical model based on that 5% differential, on the volatilities that you can see there, and on the assumption that 1 year is independent of the year that preceded it. In other words, it's just a statistical model. But I do think it's useful to put into perspective the returns of equities, that they have to be looked at long term, and that the short term there is a fair chance that they underperform cash. You will see there over a 4-year period that chance of equities outperforming cash is around 77%, somewhere around there. So this is actually just the return over the last 15 odd years, 14 years, and it's just, again, to put things into perspective, this is 10-year rolling returns. I mean, frankly, it's that sort of period that people like us should be looking at. And there's the CPI down the bottom. That's not on a rolling basis, of course. That's actual CPI year by year. I've just taken out the effect of the GST in 2000, but other than that, it's just rolling. It's actual CPI. Then the rolling cash over the top of that, and then equities, including the tax credits, sitting above that. You can see again that difference between the purple line and the red line is supportive of the 6% type assumption, 5%, 6%, 7% assumptions that historical experience tells us is reasonable. Again, we're still looking into the rear vision mirror. We're looking at the backwards. I'm going to look forwards very shortly, but let's just have one last go at looking backwards. And this is the periods over 110 years, from 1900 to 2010, breaking that period up into 11 decades. And you can see there's the real return on equities, in other words, in equities less inflation and cash minus inflation. You can see there is only one decade in the last 11 where equities have got a negative return, and that's obviously the 1970s, and only one decade when equities underperform cash, which is obviously the same decade. 10 out of 11 is not a bad batting average. We've heard a lot of commentary that really equities are too high risk and you should be in bonds, being lower risk. I'd just like to hopefully demolish that argument, because when you look at bonds, in fact, they are significantly higher risk. I'm just going to give you some very brief statistics regarding bonds, because that's not really what I'm here to talk about. But bonds, how often have they underperformed cash? In other words, there's one line there where the blue line is less than the red line, that equities have underperformed cash. How many times have bonds underperformed cash if I put up the same graph? The answer is they've underperformed cash 5 of the last 11 decades. They've only outperformed 6. The chance of bonds underperforming shares becomes, again, very high. It's 9 out of the last 11 decades. Bonds have underperformed shares. Now, trying to look forward, this is quite difficult, but at least with bonds, we do know that if you buy a bond now and hold it for the next 10 years, your yield is 3.3%. We know inflation, again, there's a Reserve Bank has a target rate, and that's between 2 and 3%. Let's just assume 2.5%. So 3.3% less 2.5% is less than 1%, expected real return going forward. I can't see that if you're trying to look after members into the future, that that's a satisfactory outcome. Bonds are in fact quite volatile over history. The reason they've been volatile is because when inflation takes off, as it does, bonds fall very, very sharply. That's really what happened in the 1970s. Bonds fell so sharply that they drag equities down with them, but they fell significantly more than equities. So, trying to look forward, I'd like now to move on to the equity market. First of all, this is just looking at, in general, how do you think about the equity market looking forward? And I've just tried to characterise the three types of mindset. The statistician, the bottom one at the bottom, is really the graph I put right at the beginning. That's the probability based on statistics. The pessimist is the one we've heard somewhat from over recent months and years, and that is that because equities have returned well over the last 110 years, that doesn't really show us very much at all. That in the future, equities may not return very much more than cash, and certainly not enough to allow for the to allow for the higher volatility that you get from equities. The optimist, which is me, is going to talk about the lower market actually gives better value, and the better value means that you should expect higher returns in the future, not lower returns. This graph here is our balanced equity management's analysis of Westpac. Obviously we value it on a continuous basis, but every 6 months we update our models for the latest financial information that's coming out of the company. And based on that, we can back solve and say, well, what future return would give you the conclusion that the market's currently correctly priced? Let's assume absolutely no growth. In other words, we don't expect a deterioration in the business circumstances, but nor do we expect any growth in the future. So it is a mathematical calculation, but it's based on our modelling of the various components of their income, and we do normalise for bad and doubtful debts and a whole lot of other operational variations, but nevertheless it is just a statistical model. So not statistical, it's a financial model of their business. Now you'll see there that, I'm not going to go through it line by line, but the point about it is that there's really two things to notice. That first of all, if in fact you have a good return, and you can see that September 2009 was a particularly good return, that half year, that pulls down the future expected return. And in fact, going into that half year period, our calculation of future return was close to 14% for Westpac. We had that extraordinarily good half year, 41% return, and that pulled down the return down to not much more than 10%. And the converse also applies in that if we have a poor return, that pushes up the expected future return. And you can look at, for example, September 10 or September 11. You can see those two significant negative numbers, minus 13 and minus 12%. They caused the expected future return to rise from 10% up to 12% in the first case, and then 12% up to over 14% in the second case. This is the way markets work. This is the way that bond markets also work. If we have a situation where bond rates fall, as they have, from 6% to 3.3% over the last 4 years, that has two implications. First of all, it means that you have a very good outcome while those rates are falling, but of course you're setting in stone lower rates into the future. The equity market, you can see it in the bond market very clearly. In the equities market, it's not quite so clear because you can get fundamentals deteriorating or improving, which can cloud the outcome. I have unashamedly chosen Westpac because, in fact, the fundamentals have remained fairly constant through the period, and the outcome of that is that those numbers sort of are consistent from one period to the next. But nevertheless, if we choose any other company, you get the same sort of thing. Sometimes you get extraneous events like push it higher or lower in any period, but over a longer period, that's the way it works. That's why we're confident that equities, in fact, will give higher returns into the future, and that the low returns we've seen over the last several years, in fact, have set up better returns into the future. The thing really to notice there is that our expectation of return at the moment for Westpac is still a touch over 12%. This is not a shabby return. Inflation's expected to be 2 to 3. Bonds are 3.3. Equities, we're expecting to be in double digits. That is after the benefit of the franking credits. These numbers here are pre-tax on Australian tax. They're actually post-tax on overseas tax, because overseas tax doesn't benefit the shareholder. Australian tax does through the franking credit mechanism. So I guess in summary, I'd just like to say that from our point of view, we believe that the experience over the last 4 years is looking backward through the rear vision mirror, look forward through the front windscreen, and you'll see a significantly better story.
Good morning, everyone. So welcome. So I'd like to offer a slightly different perspective, I guess. Very much that talk, and I think very often the perception that I see a lot about talking about equities is comparing something like equities to cash or equities to something else, and perhaps not looking at equities in the way that we consider equities, which is as part of an overall portfolio, and how much of that portfolio is dominated by one asset class. And that's what I'd like to try to give a slightly different perspective on today. Important information, the disclaimer there. I think what happens a lot with equities, and this is one of the base assumptions that I'd like to challenge today, is that people think very much that equities are high risk, high returns, that bonds, low risk, low returns, although often people are talking about bonds being sort of low returns and high risk more recently. There's very much that philosophy that you can't get your return with too many bonds. That you can't get your return with too many bonds. So therefore you need more equities. And there's some amount of, look, we're long-term investors, so damn the torpedoes and full speed ahead with that. What happens with that is that most portfolios, at least in Australia, have ended up with about 80 to 90% of their risk in listed equities. They've also got a large amount of the rest of their risk in what we refer to as unlisted equities, so things like infrastructure and property, which tend to, because of largely mark-to-market implications, not be quite so correlated over the short term. But if there is a true growth shock, if there is a real slowdown, then these have got some sensitivity to growth as well. So you end up with growth risk being the dominant and almost the only risk in a lot of these portfolios. These portfolios are very much a one-trick pony. Members can then get a very volatile ride. So on the one hand, yes, they are invested in superannuation for a long time, but often the large amounts of money, the large balances that they have only accumulated towards the end of their working life, so that they only have these balances for a relatively short period of time. While there have been some very good periods of equity returns, the order of returns we know matters. And a lot of these people have ended up with quite bad returns towards the end of their working life. And often, unfortunately, we see members switching out of a high risk or a higher risk type strategy after losses, such that if we can help them get a better ride, if we can help them get a smoother ride, they're less likely to make some of these bad decisions, and that's better for them. I'd like to challenge people to, come on, get with the program a bit. So the efficient frontier is something that we use a lot and talk about a lot in our industry here. So that's technology, that's investing technology that dates back to 1952. People have sort of moved on from that. A couple of years later, there's a capital markets line. What that implies then is that there's not sort of risky assets such as equities or growth assets and defensive assets, but there should be an overall growth portfolio. What's your best growth portfolio? And you can move that up and move that down. That growth portfolio should be a lot more diversified than something that's just relying on equities. And that, I think, is a challenge that we haven't really moved to. Very often we stick with market cap weighted equity portfolios and market cap weighted bond portfolios, just taking the off the shelf that we can get from the markets without necessarily asking the question, are these the right and the best benchmarks for investments for our members? Free your minds. So not all bonds are low risk and low returns. So if you go for longer duration government bonds, for example, so a 30-year US Treasury, for example, so that's relatively low risk in terms of getting your money back. It's about as good as anywhere at the moment. But it's got high duration volatility. If there's a global growth shock, if there's a growth shock in the US, that thing's probably going to do pretty well. Similarly, obviously the other way around, if the economy sells off, then that's probably going to do badly. But if you've got a lot of equities in your portfolio, then those two things can offset and you get diversification there. So if this thing is going to do well when there's a growth shock, and it's going to pay you some money over the long term, you're actually getting paid to have some insurance in your portfolio there. So you're getting paid for protection. Again, what we're trying to construct here is overall portfolios. What's the most robust portfolio? And if you've got things in your portfolio that when one's going up, the other goes down, you can sell the thing that's gone up and buy some of the thing that's gone down. And that rebalancing between those asset classes actually adds return above and beyond the single asset class returns that you get there. So when you're thinking about portfolios, you've got to think about the interaction between those different asset classes. So I've talked a bit about bonds here because I think they're probably the most underappreciated. I think a lot of people are already looking at different alternate asset classes, what we refer to as alternatives, property and infrastructure. Again, with a little bit of gearing in those things, you can get equity-like returns. They tend to be a little bit less risky and so lower returns. But you can get equity-like returns from those, and a lot of people add some gearing into those within structures there. And so if you combine a few of those things together, you can get a less risky portfolio than your equity-heavy portfolio and still maintain similar long-term returns. So again, there's that question, my goodness, could you possibly buy bonds at the moment? Well, I think that there's a lot of bond bears out there. And you know what? This time last year, there were a lot of bond bears as well. So I think there's two really important questions that you need to ask yourself. Is how much of your portfolio should you skew because of judgment? So if you were really bearish about equities, how little equities would you have in the portfolio? I guess is sort of a question that you should ask yourself. And again, there's very little sort of bond risk, I know, in a lot of portfolios. So the first Michael talked about reducing his duration in his portfolio to zero. Does that mean he sold all his bonds? Does it also mean that he sold all his equities? Because the research that I've seen by Marty Leibowitz and the like suggests that the inflation duration of equities, so the sensitivity to equities to a shock in inflation, is about 8 to 9 years. So that's a similar sort of loss that you would expect if you get an inflation shock from equities as what you would get from bonds. So if you're worried about inflation and reducing your duration risk, does it make sense if that's the historical experience to only reduce your equities? You should be really worried about to only reduce your bonds. You should be really worried about your equities if you're worried about inflation. So the first question is, how much of your portfolio should you move based on judgment calls? Because as we know, we can all be wrong. So should that really dominate it? The second question is, look, what does the world going forward hold? Like, can you really lay out a systematic path forward to how we resolve these issues? Again, Michael 1 suggested that you actually, without a crisis, the politicians don't act. Now, things have moved forward in Eurozone, but we know that they've got a long way to go before you get that fiscal union, before Germany's really prepared to pay away. Estimates are about 8% of its GDP to support the rest of the Eurozone there. how much of a crisis do you need before Greece is really prepared to accept all of the constraints that Germany wants for paying that money across there? So again, most people that I talk to suggest that Europe's got to get worse before it gets better. Similarly, in the US there, we've got a debt situation there. So we've got the fiscal cliff looming. So most people think that, look, they're not going to drive into that cliff, that what they're going to do is change the legislation there and not have a 5% drop into GDP because of changes in government spending. What that fiscal cliff was about was trying to help them reduce their deficit. So it wasn't actually to try and reduce their debt. It was just to slow down the rate that their debt was growing. And what they've seen is they can't actually do that. So the US deficit at the moment is about 9% of GDP. So they're borrowing about 9% of GDP and getting about a 2% growth rate. So that's not great maths. And what this fiscal cliff is telling us is that they're finding it really hard to get away from that. This debt is still continuing to grow. Now, they've got to do something about that. Everyone knows that. So they've probably got to change their tax system or their entitlements. Until they do that and people know precisely what they're going to hit, there's going to be a significant amount of uncertainty. So that uncertainty is going to stifle growth. When they actually do that, that's obviously got to cause some pain there. So the US is a pretty tricky situation. You know, China's got a lot of overbuilding over there. And there's some really big structural issues that they've got to work through. You know, people that I've sort of spoken to that are locals over there, they talk about the Chinese economy being something like the movie Speed, where they say, look, it can't slow down, otherwise it's in big trouble, but it can't keep going at those sorts of rates there. The amount of excess housing that they've got at the moment, they could probably stop building. They could stop building tomorrow and have, you know, sufficient housing for that current urbanisation to absorb the current urbanisation for about the next decade or two. So that's how much extra housing that they've got over there. And it's the big slowdown in housing which is contributed, or in housing building, which has contributed to the slowdown in demand. And that's because of some issues that some realisations about the unsustainability of what they've been doing that's going on over there. Now these are very big issues. So these debt type issues in the US and what's happening in China and in Europe, they're tectonic issues that have been building for a long time. So something like, you know, QE, that's trying to help, you know, the system through, and it's a bit of a temporary measure there. But it really isn't going to solve the longer term issues there. And so that we need something that's going to do that. So in such a world, you really want a diversified portfolio. Again, if you're really certain about what's going to happen, then great, put all your eggs in one basket there. But otherwise, you know, shouldn't you diversify your portfolio more? How much pain are you putting your members through? If the world turns out okay, we've got, you know, less equities in our portfolio nowadays. It's about 60% of risk, so it still dominates the portfolio. If the world turns out okay, if things go well, we're still going to crush our CPI plus 4 objective. We won't do as well as some other funds that have got a lot more equities, but we think that, you know, crushing that objective in the good times is all that we need to do, and we're happy to give a smoother ride. We don't think we'll get lower returns in the long run from what we're doing. In the future, though, we think as well that really in terms of what we're doing with our default portfolio, that we can do a lot better, that we need to understand members' needs more, to take into account different information that we're not using at the moment, such as the member's age and the member's wealth, to understand members' liabilities better, and to think more in terms of that asset liability management, perhaps a little bit more like a DB fund. When you sit back and look at those things, you realise that the things that are important are not so much the growth defensive risk, but things like contribution rates and age of retirement. It's different levers. And within that world, we think that there's a potential for different portfolios. If we're thinking a lot more in DB world for individual members, is it likely that we're going to have different portfolios? And if most DB portfolios have got lower equity risks, is that giving us an indication? So just something to leave you with there. Thank you.
The Equities Conundrum, we know this is something that's certainly exercising the minds of all of our clients at the moment. I'm sure it's exercising the minds of most everyone in the room. There are a couple of things I wanted to look at in trying to answer this question. Not that I think any of us will come up with a number as such, but I want to spend a little bit of time just looking back to what has actually driven equity returns and just try to understand the nature of how equities perform and what's actually driven their performances in the case of Australia, for the last 100 years or so. Now, some of that will cover terms of trade in China that's already been covered by some of the earlier speakers. And then I want to look at just where the market is currently priced and some of the issues that drive market pricing over the longer term. And then, of course, look forward, just how much money do you need in retirement and what sorts of returns do you need during the course of your accumulation phase to have enough money in retirement. So, of course, why have equities in the first place? Well, I think all of us are aware of the fact that because these are a riskier asset class, they trade at a risk premium over many other asset classes, cash and bonds. They trade with what's called this equity risk premium over those rates. So over the longer term, given the increased risk, we know that we will get a higher return from equities over the very long term, as Andrew, the first speaker, pointed out very eloquently earlier on. But we also know, as has been pointed out, that these equities are a very, very volatile ride as well. On this graph, just simply have a number of rolling return series over a year, 3 years and 10 years. The best return, of course, being over the longer run, but we know that over the shorter run, a year or 2 years, you can get a very, very wild ride. And I think that's one of the reasons, this volatility since the GFC, but also the lower returns that are really, really focusing investors' minds on just how much they should have in a portfolio when it comes to equities. As I said, I just wanted to look back a little bit at some of the building blocks, if you like, of returns for equities. And on the left-hand side here, we have Australian equities, bonds and cash. These are all real returns. These come from an annual yearbook put together by 3 fellows at the London School of Economics. So for Australia, over the period since 1900 to the end of 2010, Australian equities have returned on average 7.5% or thereabouts real per annum. Now, the thing that I find staggering about this is that if you compound that over that period of time, equities have risen by a factor of around 2,500 times. Now, in their survey that these 3 fellows do on an annual basis, they look at 19 other countries. The nearest country to Australia over that same period is South Africa, with a compound return of 2,100 times. And then places like the US come in third, with a compounded return some 800 times. And then if we go into the core of Europe, very much the topic of the day, France, Germany, Italy, real returns, or a compound factor 30 times. So 30 times compared with 2,500 times. Australian equities have certainly truly been an exceptionally different asset class to equities in most other places in the world, and the best performing market by a mile over 110 years. Now, of course, a lot of this has come more recently, given the power of compounding on a larger and larger number. And that's why I've included this graph here that looks at what actually drives equity market returns on a decade-by-decade basis. So each of these little licorice all sorts pertain to generally different decades. And we've divided them up colour-wise to look at dividends firstly. So dividends are the green component, and in every single one of those periods, dividends have been a positive and quite a sizable contributor. And that's something that has been unique, well, not unique, the size of the dividend has been unique in Australia. And even today, the dividend yield is some 5% before franking. We've also charted here the change in the PE, because it's this valuation impact that can drive the value of equities as well, on top of the dividend and on top of earnings, which we'll get to. The PE was generally positive in the first several decades of this graph, and then very negative during the inflationary periods in the 1970s. And then more recently, as has occurred globally, the Australian PE has also contracted, following on from the NASDAQ-driven mania of the 1990s. So generally a positive influence, the change in the PE, but very negative in the 70s with inflation, and very negative in the last several years as well. Finally, the EPS growth. And this is really what sets Australia apart, I think, along with the fact that our dividend yield is so high. So again, looking across the chart there, I'm not sure the guys on this side of the room, if you can see that earnings bar there, that is over the period 2000 to 2007. And that is the terms of trade. That is China, that is 3 separate listed companies on the Australian Exchange, BHP, Rio and Woodside. And over the 3 or 4 years to the middle of 2007, BHP made a contribution of between a quarter and a third of the total earnings of the Australian market in each of those years. So this is what makes Australia unique, particularly of late and building on what has been very, very solid performance. So that's the past. Whereabouts are we now? I wanted to look firstly at the PE ratio, because the PE ratio reflects what you're paying for earnings in the future. So a PE ratio of 10 means that you're paying for an individual stock or a market $10 today for $1 of earnings in perpetuity. Now we have on this chart on the left the US market. We're looking at the PE at time of purchase and then the following 10-year return per annum. So the US on the left, Australia on the right. And I hope you can see there's a much closer relationship in Australia between what you pay initially and the following 10-year return. And this is, of course, this makes common sense really. The more you pay for something, the less your return is likely to be, and the less you pay, the lower the PE, the higher is your return likely to be. And where we stand today, just looking at this scattergram with the PE on the Aussie market at around 11.5 times, that's toward the lower end of the range. And if history is any guide, it may not be, but if it is, that would suggest that the next 10 years are likely to be some quite reasonable returns. But there's something else that really, really affects the PE, and we think has had an impact on the PEs that we see globally now, and that is volatility. Volatility in both growth and volatility in inflation. And that's what we've charted here, some work we've just completed recently at Frontier. And we've looked at growth and its relationship with the PE, we've looked at inflation and its relationship with the PE, and there is an inverse relationship there, as you can imagine, but it's really the volatility that really has the biggest single impact on the PE. And we think this is because it's volatility and uncertainty which has the biggest impact on what investors, about how confident investors can be about future cash flows. And we've had most every speaker today talk about all of those uncertainties of very, very significant magnitudes. So we think it is that uncertainty that is leaving us with these low PEs. So having said all that, just exactly what sort of return do we need in a fund to provide a reasonable return for members? Now we have here some modelling we've done using an ASPA website, and what we've looked at is males and females, and for females we've taken some assumptions about how many years they may spend out of the workforce. We're talking about a zero balance to start with. We're talking about a 9% contribution year in, year out, which we know is incorrect, but we've just started with that as an assumption. And we're using average weekly earnings, we're using an inflation rate of 2.5%. And most importantly, in the context of this analysis, we're talking about a real return for the fund of 3.5% per annum. And even with all of those assumptions and pretty reasonable returns, we find out that for a single male, they would run out of money on having a reasonable retirement at the age of 91, and for females even earlier. So that really just underlines how incredibly important it is to get those sorts of returns, CPI plus. Just finally, we have a number of clients, and I know broadly speaking this is across the industry, that there's a lot of concern about the volatility of equities, and a number of people are thinking about other ways that they can try and find these returns of CPI plus 3.5 without some of the volatility of equities. And these are just some of the areas where we've been looking with on behalf of clients. Floating rate debt in particular we've been looking at, and there's been of late more interest in some of these CPI specific funds structured to look at a CPI plus. And of course one of the other ways to invest in equities with some protection of course is to use options. So I might just leave it there. Thank you.